For years, decades even, I've been watching these markets, scrutinizing every tick, every trade, every whisper. And what I've seen, what we've all seen, are patterns. Some say it's just the ebb and flow, the natural rhythm of capital, the invisible hand of the market guiding prices to their true equilibrium. But I tell you, sometimes those patterns become so glaring, so mathematically improbable, so utterly perfect in their timing, that you have to ask yourself, is this truly organic? Is this the impartial, dispassionate dance of supply and demand? Or is something else, something far more deliberate, far more orchestrated, at play? And when we talk about deliberate, when we talk about what seems to be the very orchestrators of market sentiment, the entities capable of bending entire asset classes to their will, one name inevitably rises to the surface, especially in the precious metals space. A name that, for all its colossal power and ubiquitous influence, often operates in the shadows, or at least just outside the direct glare of mainstream scrutiny and critical inquiry. Yes, I'm talking about the financial behemoth JPMorgan. And what I'm about to lay out for you regarding their activities, particularly around a very specific critical moment in recent market history, might just make you question everything you thought you knew about market efficiency, regulatory oversight, and the very concept of fair play in our so-called free markets. Think back, if you will, to the tumultuous period we've navigated recently. We've lived through unprecedented economic uncertainty, monetary policies bordering on the surreal, with endless quantitative easing and zero interest rates, and geopolitical tremors shaking the very foundations of global stability. In such an environment, where does one expect safe haven assets, particularly gold and silver, to thrive? Logically, fundamentally, historically, they should soar. They are the ultimate hedges against inflation, against currency debasement, against systemic risk. Yet, time and again, we've witnessed these metals, particularly silver, being driven down, almost systematically, against all common sense, against every fundamental indicator. Why? Who benefits from such inexplicable moves, moves that seem to defy gravity, or rather, defy economic logic? This isn't just about price volatility, mind you. Every market has that. This is about a persistent, almost predatory suppression, a relentless downward pressure applied even when every signal points upward. And the instrument often used for this suppression? Massive, concentrated short positions in the futures market. Imagine, if you will, a single entity or a very small group of entities holding an overwhelming percentage of the shorts in a critical market like silver. Positions so vast, so disproportionate, that they possess the sheer financial weight to bend the price to their will, to create artificial supply that simply overwhelms genuine demand. This isn't just a theory proposed by some fringe elements. It's what we've seen documented, analyzed, and discussed by astute independent financial analysts and ourselves in the precious metals community for years. But what happens when those shorts, those colossal, market-defining positions, suddenly vanish? And more importantly, when do they vanish? The timing, my friends, the precise surgical timing of these actions, is what truly sets off alarm bells for me. It's not just that they were closed, but the exact moment they were unwound. It points to a level of foresight, of strategic precision, that frankly transcends mere superior market analysis. It suggests an almost preternatural understanding of future price movements, a kind of omniscient view of the market's turning points. How could one entity consistently possess such uncanny, unerring timing? Is it simply superior research, a sophisticated algorithm predicting every market tremor? Or is there something more profound, and perhaps more troubling, lurking beneath the surface, manipulating the very fabric of price discovery? Let's delve a little deeper into the mechanics here. For those unfamiliar, short selling in the futures market essentially means you're betting that the price of an asset will fall. You sell a contract you don't own, with the obligation to buy it back later at a lower price, pocketing the difference. Now, for the average investor, this is a speculative move, a risky bet. But for a gargantuan entity with seemingly limitless capital and a dominant market position, it becomes a tool of influence, a lever to push prices down. By continuously rolling over or adding to massive short positions, especially when there's limited physical supply to absorb that pressure, you can create an artificial ceiling on price, suffocating any rally, grinding sentiment down to dust. For years, we've watched the weekly commitment of traders, or QOT, reports published by the CFTC. These reports, while delayed and imperfect, give us a glimpse into the positioning of different market participants, categorizing them as commercial, non-commercial, and non-reportable. The commercials are supposed to be the hedgers, the producers and consumers looking to lock in prices. But a subset of these commercials, particularly the large banks, have repeatedly been identified as holding truly massive, persistent net short positions in silver that stretch the definition of hedging to its breaking point. These aren't temporary hedges. These are strategic market-moving positions. And who has consistently been identified as the largest, most dominant of these commercial short holders in silver? Yes, JPMorgan. For well over a decade, their shadow has loomed large over the silver market. Independent analysts, like the tireless Ted Butler, have spent years meticulously tracking these positions, pointing out the sheer scale of JPMorgan's short book, often representing a significant fraction, sometimes a majority, of the entire commercial net short position. Think about that for a moment. One bank holding such an outsized, persistent position in a crucial global commodity. It beggars belief, doesn't it? It certainly raises profound questions about competition and market concentration. The impact of these immense short positions cannot be overstated. They act like a weighted blanket on the price, preventing any sustained upward movement. Every time silver tries to rally, these shorts are there, adding pressure, forcing liquidation from smaller players, creating a cycle of pessimism that drives prices lower. It's a strategy designed not just to profit from a falling market, but to create a falling market, or at least prevent a rising one, allowing accumulation at lower levels. Now, before we dive deeper into the specifics of this remarkable occurrence, if you're finding this information valuable, if it's sparking questions in your own mind, please hit that like button right now, and consider subscribing to the channel. Your support is absolutely crucial because it helps us bring more critical insights like this to light, challenging the narratives the mainstream often ignores, and empowering you with knowledge that can genuinely impact your investment decisions. So we have a market known for its susceptibility to large, concentrated short positions. We have a dominant player, JPMorgan, consistently identified as being at the very top of the short sellers list in silver for an extraordinarily long time. And we have prices that time and again seem to defy fundamental logic, driven down even when all economic indicators scream for higher values for precious metals. Now let's bring it all together and ask that burning question once more. The question that is at the heart of this entire discussion. When you see those massive shorts disappear, not randomly, not gradually, but at precisely the most opportune, most advantageous moment imaginable, can we truly chalk it up to a mere coincidence? Can we dismiss it as just the unpredictable whims of the market? I'm talking about a period where the silver market, specifically, reached what many believed was its absolute nadir. A point of maximum pessimism, where sentiment was crushed, where retail investors were throwing in the towel in despair, and prices appeared to have nowhere to go but up. A moment of capitulation, where the weak hands were flushed out, and the market looked utterly beaten down. And then, like a magician disappearing their trick, JPMorgan, which had been holding a truly staggering number of short positions that had held the price down for so long, that had created this very bottom, suddenly unwound a massive chunk of them. We're talking about 633 commercial short contracts. Now, 633 might not sound like a monumental number to some, but understand the context here. These weren't just any contracts. These were positions so significant, so influential, so central to the price suppression mechanism, that their sudden disappearance had an immediate, profound impact on the market's dynamics. It was a substantial reduction, a pivotal move. And the kicker? They were closed, almost to the day, at the very bottom of that price decline. Think about that for a moment. They weren't gradually reduced as the price ascended, giving an impression of prudent unwinding. No, they were gone, vanished, just as the market turned on a dime, just as the price began its ascent. How does one achieve such flawless execution, such perfect timing, repeatedly, consistently? Is it simply the luckiest bank in the world, or are we witnessing something far more calculated? This wasn't an ordinary trade. This wasn't hedging gone right, or a brilliant speculative bet that happened to pay off. This was a strategic retreat, executed with surgical precision, freeing up the market to finally express its true value, but only after the dominant short seller had exited their positions at maximum profit, or perhaps at minimum loss for having held the line for so long. It left everyone else scrambling, wondering what just happened, while one entity walked away with unprecedented gains and a pristine book, ready to capitalize on the ensuing rebound. The implications of this are enormous, touching upon market integrity, regulatory oversight, and the very nature of price discovery in critical asset classes. We've only just scratched the surface of this intricate web, this astonishing pattern of behavior. In Part 2, we're going to delve even deeper into the mechanics of how this is done, the potential motivations behind such persistent market manipulation, and what this recurring pattern implies for the future of precious metals investing, for your portfolio, and for the very concept of a free and fair market. So, if you're intrigued by these coincidences, make sure you've hit that notification bell so you don't miss the next installment of this crucial discussion. And share your thoughts in the comments below. What do you think about coincidences of this magnitude and frequency in our markets? Do you think they're truly random? We left off with a question, didn't we? A fundamental, almost unsettling question that hangs over the very integrity of our financial markets. We were discussing JPMorgan, one of the largest and most influential banks on the planet, and their astonishing timing in the silver market. Remember, it was a moment etched into the charts for anyone paying attention. 633 COMEX, silver short positions closed, right at the absolute market bottom, the lowest point, not a low, but the low. Now I ask you again, with all the conviction I can muster, coincidence? Or something far more deliberate, far more calculated? The notion that such precision, involving hundreds of millions, indeed potentially billions of dollars when you consider the broader context of their positions, could be mere chance, stretches the bounds of credulity to a breaking point. It's an idea that requires you to suspend disbelief, to ignore what your eyes and your common sense are telling you. We're talking about an entity with unparalleled market access, intelligence, and capital. They are not merely participants. They are, in many respects, the architects of significant market movements. For those of you just joining us, or if you need a quick refresher, the core issue is simple yet profound. JPMorgan covered 633 of their COMEX silver short positions at the precise moment silver hit its absolute nadir, only for the price to rebound sharply thereafter. This wasn't some minor retail trade. This was a move by a titan, a move that sent ripples through the entire precious metals complex. This isn't just about a trade. It's about the very fabric of market fairness. It's about whether the average investor, the individual who plays by the rules, who researches and invests based on fundamentals, stands even a remote chance against the colossal forces that seem to operate with impunity in the shadows of the financial world. It's about understanding who truly dictates prices, and whether those prices genuinely reflect supply and demand, or if they are, in fact, managed. And if you're starting to feel a flicker of suspicion, a sense that something isn't quite right, then you're exactly where I want you to be. Don't forget to hit that like button if you're finding this information valuable and thought-provoking. It really helps us bring these discussions to a wider audience. But the story goes deeper than just this one silver incident. Once you see the pattern, once you understand the modus operandi, it becomes an undeniable blueprint. This single event, while striking, is merely a microcosm of a larger, more systemic issue that has plagued the precious metals markets for decades. It's a recurring theme, a familiar play acted out repeatedly on the grand stage of global finance. It's the art of market subjugation, where the overwhelming power of paper derivatives is used to suppress the true value of physical assets. Let's consider the sheer scale for a moment. Each COMEX silver contract represents 5,000 troy ounces. So 633 contracts amount to 3,165,000 ounces of silver. At the approximate low point of, say, $12 an ounce, that's nearly $38 million just for those specific contracts. But that's just a snapshot. JPMorgan's involvement in the silver market, particularly their short positions, has historically been far, far larger. We're talking about an institution that has, at various times, held short positions representing hundreds of millions of ounces of silver. This specific covering of 633 contracts wasn't just a trade, it was a strategically timed maneuver within a much grander, more intricate game. Think about the implications of having the power to essentially drive down the price of an asset, accumulate it on the cheap, and then profit immensely from its inevitable rebound. This isn't just smart money. This is market power taken to an extreme. It's a self-fulfilling prophecy orchestrated by those with the means to move mountains of capital. They suppress the price through massive short selling in the paper market, creating a perception of weakness, discouraging buyers, and forcing out weaker hands. Then, when the market is sufficiently battered, when sentiment is at its lowest and retail investors are capitulating, they swoop in, cover their shorts, and often simultaneously accumulate physical metal or establish long positions, setting themselves up for enormous profits as the market recovers. And this isn't a new phenomenon. History is replete with examples of similar patterns, particularly in commodities. While I cannot, of course, definitively state intent on JPMorgan's part in this specific instance without being privy to their internal communications, what I can tell you is what the observable facts present. And the facts present a highly sophisticated entity executing a move with astonishing precision at a critical market juncture. When we look at JPMorgan's track record, the fines they've paid for spoofing in the precious metals market, the settlements they've reached for manipulating futures markets, it paints a picture of an institution that is no stranger to aggressive market-moving tactics. It's not about accusing them of a specific crime here, but rather understanding the historical context and the immense power they wield. For us, the investors, the producers, the individuals who believe in honest price discovery, this is critical information. It dictates how we understand risk, how we interpret price movements, and ultimately, how we allocate our capital. If you believe that the markets are purely efficient, purely driven by supply and demand, then you might see this as an extraordinary stroke of luck. But for those of us who have watched these markets for decades, who have seen these plays unfold time and time again, luck begins to look a lot like strategic advantage. This isn't about blaming anyone. It's about understanding the reality of the landscape we operate in. If you're gaining new perspectives from this discussion, please consider subscribing to the channel. Your support helps us continue to shed light on these complex market dynamics. So, after all this, the central question remains, doesn't it? Coincidence or calculated strategy? The sheer improbability of such precise market timing, consistently executed by the same influential players, moves beyond the realm of mere chance into the domain of deliberate action. The evidence, when viewed holistically, paints a picture that is anything but coincidental. It speaks to a sophisticated, systematic approach to market control, an ability to influence prices through overwhelming paper positions, creating artificial troughs from which they can then profit immensely. This is how it works. They use the vast leverage of the paper futures market to create an illusion of abundant supply, suppressing prices. This suppression then impacts the physical market, making it appear less attractive for producers and discouraging new investment. As prices drop, weaker hands are shaken out, often selling their physical holdings or liquidating their long positions at a loss. At the very bottom, when the market is utterly despondent, when everyone has given up on silver, that's precisely when the shorts are covered and new physical positions or long contracts are accumulated. This cycle allows powerful entities to acquire valuable assets at incredibly discounted prices, only to profit from the inevitable rebound when the true underlying fundamentals of supply and demand eventually assert themselves. This isn't just a lesson in market mechanics, it's a stark reminder of the immense forces at play in our financial world. It underscores the importance of understanding the difference between the paper market, which can be manipulated, and the physical market, which represents tangible wealth. It emphasizes why assets like physical silver and gold are so vital in an environment where paper promises can be bent and twisted to serve specific interests. My belief, and what the data strongly suggests, is that such precise timing is not an accident. It is a testament to the concentrated power within the financial system, a power that, at times, can overshadow the fundamental truths of supply and demand. The implications for you, the individual investor, are profound. It means you must be acutely aware that market prices, particularly in the short to medium term, might not always reflect true value. It means seeing through the noise, understanding the underlying fundamentals, and having the conviction to hold on to your precious metals through periods of manipulated suppression. It means recognizing that opportunities often arise precisely when these powerful forces are attempting to create maximum despair. What does this all mean for us going forward? It means we must remain vigilant. We must continue to question, to analyze, and to speak out when we see these patterns emerge. The more eyes on the market, the more people understand these dynamics, the harder it becomes for such maneuvers to go unnoticed or unquestioned. Your awareness is your greatest defense in a market that can be so heavily influenced. So I urge you, share your thoughts in the comments below. What do you believe happened, and how do you protect yourself? Join our community by subscribing to this channel, and make sure to hit that notification bell so you don't miss our next expose and our continued efforts to bring transparency to these critical markets.